Okay. Welcome back to the Compassionate Capitalist Show. So, we spend a lot of time on this broadcast. Our regular listeners know they tune in to hear messages of how to, and yes, you can, for creating wealth by building successful companies that can exit, and the best practices for investing in those up and coming great companies. This show is going to be a little bit different because today we're going to talk about other types of exits, leverage buyouts, and also bankruptcy. Uh, they, as I was, my guest informed me, and because we always try to have experts on these topics in here, that leverage buyouts gets a bad rep that they don't always deserve, and so we're going to explore that topic because I had it down as a kissing cousin to bankruptcy, and apparently it's not as much. But bankruptcy is one of those exits that investors and founders want to avoid, and hopefully by the end of this segment, you're going to understand the importance of not just business planning and strategy, but mirroring in the financial aspects of that when you're making any form of decision about growth or change in trajectory or an acquisition to grow or a launch of a new product as your company is moving and growing. Because a lot of times when I work with startups or early stage companies that are struggling to raise capital, or they get into that situation where they're the what I call the midlands of a portfolio, the ones that are underperforming what they were expecting to do based on their forecast, it is usually because they have not properly planned their financial aspects of what they're going to do in their business. They don't, they underestimate the capital infusion they're going to get, the cash flow they're going to have from their revenues, and just in the reality of when founders miscalculate both of those and why they end up either being a midland or a failed company in a VC or angel capital portfolio. So, and as always, we have a highly entertaining and experienced guest to lead us in our knowledge and exploration. Chris Reilly, for those that are watching, he's sitting here patiently waiting for me to bring him on. He is the founder of Mission Capital Consulting and the brains and vision behind digital courses marketed as financial modeling education. And the links are down in the show notes for those, and I'll give those to you. That financial modeling education is what is really important within this context, because for it, if you're listening to this show right now, your CFO or your person who's managing the financial aspects of what you're doing as your strategy going forward needs to know about this podcast, and they probably need to go to financialmodelingeducation.com and make sure that they are up to speed and fully understand the power and the message that the financial statements that we'll talk about. It's the three questions or the three documents, I think, that Chris loves to, when he really understood it, really set him on the trajectory that he's on right now. So let me tell you about Chris. He is a financial expert with a diverse background encompassing consulting, corporate finance, and private equity. With a passion for private equity, he ventured into middle market private equity in Denver, refining his skills over a decade. He is an influential figure in finance, shares his insights with a whopping 92,000 followers on LinkedIn. I just looked that up today. So it's even more than when he first came across my desk as a potential guest on this show. And he does that because he simplifies complex realms of finance with his expertise. It takes a really high level of expertise to understand something so well that you can then put it into layman's language that people like myself and you that are listeners will understand this and have a better knowledge of it so that you can hire the right people to do the work for you or to assist you in the process of what you need for growing that. At his firm, Mission Capital Consulting, he provides custom built M&A and LBO models and FP&A models. And there's a lot of acronyms there, which we will dive into the difference of what to consider as we explore the topic, well, quite frankly, of finance planning and acquisition. That's what the FP&A stands for. So that as you my listener enter into a growth stage to attract profitable acquirers to merge and acquire your company. That's an M&A acronym, to avoid the exit strategy of a bankruptcy, but potentially used LBO, leverage buyouts, in order to, as a growth strategy for your company, because not everybody can go from angel investor to venture capital, and not everybody, and it, but sometimes the private equity markets are a good source of growth capital. And as you're going to learn in this particular podcast, the leverage buyout, and how it is a lot better than what uh I would say Hollywood makes it out to be. So welcome, Chris.
Oh,
Delighted to
thanks.
have you on the Compassionate Capitalist Show.
Yeah, thanks, Karen. I'm really glad to be here. Thanks so much for having me. I appreciate it.
Okay, so let's get started with because this is one of the things that when you're in your bio, I thought was really, really interesting, because I would love to have been a fly on the wall at that time. And what I'm referring to, listeners, is the collapse of the financial powerhouse of the Lehman Brothers and their bankruptcy filing during the 2008 financial crisis. It contributed to the collapse of the worldwide financial markets and the realization that what goes up on financial values likely will come back down, particularly when those values are fantasy fueled by financial greed without merit in the true value of the asset. And that's talking about the real estate bubble that we experienced at that time. So, Chris, tell us, at the time you were working for a company, FTI Consulting, were you already consulting with Lehman, and we're trying to avoid this, or did you come in to sort of, put out the fires? Talk about your experience and how you came to be a part of that whole historic situation.
So I came in about a year after Lehman had filed for bankruptcy. It was actually my
Okay.
final year in college when they filed in the fall, and then I started working for FTI in the following fall, 2009. And so I basically came in to, clean up the mess, as it were. And it was my first couple of weeks on the job ever, and I was in the middle of New York City in Rockefeller Center, just kind of figuring out what was going on. Went into the Lehman building, and our job was to unwind the derivative portfolio, which really just meant try to place a value on all of these derivative and swap contracts that had ultimately led to Lehman's
Yeah.
bankruptcy. And so
Yeah.
going into the building was kind of like the movies. I don't know if you've seen The Big Short or a couple of other movies like that. Empty offices, pretty sparse, just kind of some, busted boxes and computers and that kind of thing. It really sort of looked like a corporate wasteland in there a little bit. And we would set up a small pocket for our FTI team to work and just chip away at those derivative portfolios one by one. We wanted to come up with a fair or reasonable value for each contract so that ultimately in the bankruptcy they could pay back the stakeholders, in the order of priority. And so I worked on that for almost a year. I was valuing interest rate swaps, credit default swaps, foreign exchange swaps, all these things that I didn't really know what they were when I was first exposed to them. I got pretty good at it over time. And that was what I was doing. So did it for about a year until we could help unwind the Lehman portfolio. And then as that wound down, I actually transitioned to a different consulting role where I was helping Hilton, the hotel company, and that was more of an FP&A pure play role after that. So, but the Lehman onboarding process was quite an eye-opening experience to like kick off my foray into the working world.
Yeah, so I remember when all of that was happening, because one thing that we have, it's interesting how our government regulations will can the reality is that our elected officials typically do not have deep financial skills, and make they will change laws based a lot on lobbyists that want to do something, and in this particular case, so the stage was set for what happened with the 2008 meltdown of the financial markets, and Lehman being one of the dominoes that triggered that, because of a bill that passed in 1999 the Modernization Act. It was formally, it's got a, much, all these guys' names on it, but it was that was Graham Leach Bill Bliley Act, the Financial Services Modernization Act, which at the time they believed that because of a prior act, and I think dating back all the way to back into the Great Depression, when they separated all the financial houses and they required all of this transparency that you had to report what was going on, what was being sold here, who was buying this, and all this kind of stuff. And then under the Modernization Act, they said, oh, because we have all of this digital communication, that's why it was modernization. And, banks should be able to better serve their customers, because if they are doing financial planning and wealth management, they can sell them life insurance, they can refinance their house and mortgage stuff, they can do lending, they can do all this stuff under one house. And that sort of set the stage for, nobody anticipated it. It was pretty much passed unanimously by our Congress and signed in by Clinton as the last thing they did before he left office. And then, we fast forward, and you just never know. Money has a life of its own, and it finds the little crevices and cracks to get through that. Somebody can make some more money. And then as I looked up, it said the hubris of that, which I think there was a lot of concerns for people that didn't live through that and saw us come through the other and saw that the Dodd-Frank Act was passed in order to do that. When Silicon Valley Bank failed, a lot of people were very concerned that we were going to have a repeat of 2008 and 2010, particularly because we had all these dynamics of, are we in a recession? Are we in inflation? Where are we? And all that. And then now they've passed some other things that are hoping to keep what happened with Silicon Valley Bank. They didn't have enough cash on hand to cover their leverage, that we would improve that, and hopefully going forward that we won't have that same sort of potential. But I don't think you can ever predict exactly what was going to happen in the financial markets. Even with the greatest computers and artificial intelligence, there's still, I think you had another podcast where you talked about this, it's still up to a lot of just the human aspect of looking at, because human behavior is not predictable. It can be somewhat predictable. And so, the things that swing markets a lot of times aren't just computers and, zeros and ones. It's a lot more than that can swing a market. So with that, I want to talk about, let's move over into how you moved into the private equity. So you had sort of this non-traditional background, and it looks like you kind of got the bug of that leverage buyout financial model because of, what those two different experiences. Talk about what set the stage for you going and starting your own consulting firm, and then ultimately creating this financial modeling education. Because I really do think, even with people that have their MBAs and people that maybe go into, people that are in finance understand it, but people really don't understand, particularly founders and angel investors that are listening to this podcast right now. They don't understand the importance of those three documents, that, the three statements that changed your career trajectory. So talk about how you fell in love with that, the FP&A model of it, and set the stage for what you're doing now. And then we'll get into talking about how that actually works for companies in their growth stage and making decisions.
Sure. So, like I mentioned, after the Lehman engagement, I started another engagement still with FTI for Hilton Worldwide, the giant hotel chain. And they were owned by Blackstone at the time. So they're owned by private equity. And I'll never forget, I was looking at some document somewhere, and I saw the name of a young man on the Blackstone board who was basically on the board of Hilton as well. And he was only 32 years old. And I think I was 26 years old at the time. And I remember thinking to myself, how can somebody so young be in such a prestigious position? And so that was kind of where the bug came from.
Okay.
And I started to research private equity and how it all worked. And I realized that it's this process of buying and selling companies. And if you are in that industry, then you are quickly accelerated to a seat at the table in terms of either a board position, or you're at least always talking to the management team all the time, especially in the segment that I got into, which is called the lower middle market, which is smaller companies, much smaller than Hilton. So I spent a lot of my off hours just researching this industry in general, and I learned that a lot of these PE deals, at least in later stage companies, acquire companies through what's called a leveraged buyout, where they raise some debt and they raise some equity to buy a company, just like if you're buying a mortgage on a house. Same idea. But the model to build is complicated. So I taught myself how to do that in my spare time because I knew I would need it for the interview process, which I did. And so we were going to relocate to Denver anyway, just for family reasons. And so I was shopping around for companies out here. And one enough was kind enough to take me on, even though I had this non-traditional background. And non-traditional just means I wasn't an investment banker. Usually an investment banker, you go for 2 years, then you go to PE, leave and get an MBA, and then come back. That wasn't me at all. I did consulting and corporate finance. So they wanted somebody with my skill set. Uh, Went out, did the interview, did well on the modeling test, and thankfully got the job. And so that's how I really launched my private equity career. And since the companies were, again, what's called middle market, these smaller companies that do typically 100 million or less in revenue, I was immediately exposed to the management team at every single company. And this led me to realize kind of what we've been talking about here a little bit. The financial foresight or financial acumen of these businesses was not nearly as sophisticated as the company investing in it or the company that was potentially buying it. And so my job as this newly minted associate was to come in and bridge their FP&A process of the portfolio company and kind of couple that up with the leveraged buyout that we had completed to own it in the first place. And so that was how I learned FP&A and private equity sort of all in one by helping manage the portfolio companies that we acquired. And so I did that for several years, better part of a decade, and then in 2020 decided to go out on my own to teach financial modeling because one, I was just really good at it. I liked it. It was my favorite part of the business, and I always felt like people responded well when I helped them learn how to do it in the first place. And so I've been doing that ever since, basically teaching people to build these sophisticated models, but then also helping companies building them themselves if needed. And so that's where I am today.
Okay, so so one thing that hit me as you were talking, and then we're going to dig into the financial modeling part of it.
Mhm.
But because we talked earlier, and because of the sort of marketplace idea of an LBO as not being a leverage buyout, not being um, necessarily a good thing for a company, because of movies that talk about corporate raiders and all that kind of stuff, and looking at the assets under management and what can they liquidate in order to pay off the debt, and those are all the bad stories that you hear about that you do. But it hit me that I would say, and tell me if I'm true, if I'm in the ballpark on this, every private equity firm investment, whether it's a minority majority investment, probably maybe not the minority, but if it is a majority where they're targeting a company that could be potential roll up into another company that now has multiple divisions or different pieces, or if they're one of the exit strategies that I have been an advocate for, particularly for companies that are lifestyle businesses, um, is or they're not something that was angel backed or venture backed, or maybe they were angel backed and then they didn't get their venture backed, but they're now working towards how do they get to an exit. And typically it's to a private equity fund if it's not a corporate acquirer. It's almost always leveraged, because why would you put straight cash in on something that you could get borrowed money for, particularly if you could, then, pay off that debt in short order, and it's not long-term debt, or you get really great interest rates for long-term debt that has other things. So is it, are almost every any majority acquisition by a PE fund really have some leverage element to it?
I mean, typically, because you touched on it there, it's a leveraged buyout is the same concept as a house. You can take on a mortgage to acquire a house, and so long as your job can cover the mortgage payments, well, then you can purchase a house that is much more expensive than what you could pay for in cash. It's the same idea, right? If you can, $1 million home is available to lots and lots of people because of the mortgage. And so long as you can pay the debt, then you can live in the home. And so private equity has the same approach to companies. They can bring not as much equity to the deal. They can finance most of it through debt. And so long as the company continues to operate well and pays off that loan, well, then they can distribute the equity investments to other companies. And so it diversifies the risk and it also increases the return if there's a very favorable exit. So the thesis behind the leverage buyout is really the same concept as just buying an expensive house.
Yeah. And it's so for those listeners that had listened to the Rashawn Williams podcast a couple weeks ago, on if not go back, because he talks about how the most wealthy pay very little taxes and continue to compound and create multiple revenue streams because they'll buy smaller cash flowing businesses using a debt instrument along with cash to buy it, and the cash flow pays off the debt, and then they can take out a different loan on that business to then buy another business that then pays off the debt, and they just roll their money and their ability to get a loan or to leverage the businesses as they accumulate multiple small businesses. And so that's a lot of how private equity funds, I guess, work, where you can have the, funds with maybe 20 million under management, but they end up having a portfolio of 100 million because they've been able to leverage and grow those companies using a combination of debt and equity.
Yeah, it's mostly correct. I'd say they don't use existing companies as collateral to finance other companies, but what they will do is your example was kind of right of they might raise an equity fund of around $100 million of just pure play equity cash, but then they can end up acquiring about $500 million of enterprise value because they can raise the other 400 through debt. And that's just through finding various deals. And then to tie it back to financial modeling, part of getting that debt in the first place is the private equity firm has to build a fairly detailed financial model, submit it to the lender so that the lender can determine whether or not they will take on the debt in the first place.
Okay, so okay, so is the okay, let's get into the financial modeling. So when you're doing a financial modeling, um because you help companies on both sides of that, for the LBO as well. So is the process of what you look at the same for that growth strategy? I mean, because one is focused on paying off debt on one hand and growth, and the other one is pure, do you have the resources to grow, or will you have to bring in additional capital? I mean, maybe let me ask you this: does a company that's thinking they want to acquire another smaller company, or they want to launch another product, because that on top of their existing products or expand into a different sector, and they don't have the cash flow to do it, and they can't go get a loan to cover that, all of that, they need to have some hybrid, which we advise them on different ways to go about getting that capital. And a lot of times they're too small. Some of these companies that might be, you know, 5 or 10 million in revenue, they're too small for most private equity funds. Would they reach a conclusion that they could address almost like a leverage buyout formula, even though they were pursuing it as a growth strategy under financial planning? Tell me how I'm getting my documents and my language on this confused, that how, because it seems like you would do financial planning and analysis on all of it, but there you've differentiated FP&A from LBO. So talk about how analysis is used on either on for both of those functions.
Yeah, so I think there's a common misunderstanding that FP&A and private equity are different things, and really they are intermingled discipline. And FP&A for financial planning and analysis just really means let's look at the company, however it exists today, and see if we can make a thoughtful estimate as to how it's going to perform in the future. And so we're going to be building out the revenue, the cost of goods sold, and the expenses. And we're going to see what kind of cash does this business generate. What an LBO does is it's going to take that FP&A analysis that we've already completed, that projection, and all it's going to do is change the balance sheet a little bit. So the LBO is going to add additional equity capital to the balance sheet. It's also going to add additional debt capital to the balance sheet to acquire the business. The difference between an LBO and maybe doing like a Series A, B, C round is that when you do a Series A round, that cash stays in the business because it's usually not cash flow positive. So it might be a $10 million infusion. It sits in the company's bank account. In an LBO, what's happening is the pre-money and the post-money valuations are the same. And so you're basically buying out an existing position of the owners or current shareholders and kind of reshuffling the equity structure or the cap table of the business. So there's not new capital into the company unless that's organized as part of the deal. So typically it allows the current owners to take out some cash and get a little bit of a payday and de-risk their whole investment in the first place, but then work with a private equity firm to grow it in the future. So when they're determining if the LBO is worthwhile, they're really just taking the FP&A analysis and saying, now can we add an additional expense on this business's books to cover the interest and principal payments of the debt that we're going to put on it? So they are very intertwined. And truthfully, the way I learned FP&A was just by helping the private equity portfolio companies that we owned build out their projections, because that's the discipline that you're doing at the end of the day, seeing what do we think we can do in the future, and then how can the financials of the company change now that we have at least a reasonable estimate of what it might do.
And so is that done through a lot of what if scenarios? What if this happens? What if that happens?
Yeah.
To
Yeah, absolutely. So you'd come up with like a base case. So like we just simplify it. Let's just pretend, it's next year. We're going to forecast 1 year. And we sit down with the team and we say, okay, what do we think we can do? That's what I'd call our base case. And then we'd say, what do we hope we can do? That's probably our upside case, or if stuff goes really well. And then we say, well, what do we do if everything just crumbles and the business drops by 60%? What happens? And when you're paying off debt in the form of an LBO, that number never changes. You're always going to be paying the interest, you're always going to be paying the principal. And so that number remains. Whereas with the rest of the expenses, you can let people go if you need to. That reduces cost. You can cut back on software. You can cut back on other things. And so you do this stress testing to see how much can the business be squeezed so that it can still make its debt payment. And so a lot of the validation of whether or not we can move forward with the LBO is how well does the company perform in a downside scenario. And so that's a big part of the model, is really getting comfortable with the three scenarios to then decide, all right, are we going to move forward or not?
Okay, so let's talk about when you're doing that analysis, because I think this is part of what is just critical and overlooked when it comes to the very early stage companies, because there's a lot of unknowns. So you sort of and unfortunately a lot of venture and angel type of investments, because they know that there's an unknown factor there, they just sort of discount. Like, you can never believe what anybody forecasts for 5 years, and so they just don't even really count it. But to me, there's so much of that tied into the valuation and what the potential exit has to be in order to get the return on that it really needs to be done. And I think one of the things, and so tell me when a company, the thing that I think people miss a lot of times on this is the soft dollar versus the hard dollar expenses that different scenarios might incur, and soft dollar being employee retention or lack of, and the cost of hiring up somebody, the cost of old inventory not moving in the way that you thought, or in what we've experienced recently, supply chain challenges that what is the cost or the potential cost of lost business because you can't get product to fill. So does the FP&A that you conduct or you teach on, consider some of those soft dollar things that are you're aware they're around, but you may not, know how to actually calculate them.
Yeah, I think all of that sort of plays into the scenario analysis that we mentioned, especially in the downside scenario. You're basically stress testing the business with all those potential market or financial factors to ultimately say to yourself, well, how much cash can the business generate? I think financial modeling is always wildly overcomplicated. And really the goal is, can the business spit out enough cash to pay off the debt or pay back the shareholders? Yes or no? And that's really the thesis, and that's why the downside scenario is so important. And as you run that downside scenario, you start asking all the questions that you just brought up, employee retention, customer concentration, debt payments, stale inventory, that all kind of factors in. And then you see what is sort of left over on the downside. And you mentioned, the angel investing or the VC. The model isn't quite as helpful at that stage because there are so many unknowns, like you mentioned. And so usually at the angel or VC stage, you're kind of investing in an idea, you're kind of investing in people and the founder, and the pre-money valuation is a little bit more of an art than it is a science. And it's, you kind of look at similar comps in the industry and you start there and you build up that portfolio, and hopefully one returns the rest. When you get into later stage and you're doing LBOs, it's much more scientific because the business has been profitable for a while. And so it's a little bit more straightforward to forecast the future, get a good grasp on what kind of cash it's going to flow off, and then if it can return the debt. And so building a fair market value from the EBITDA, much, much simpler at the LBO stage than it is determining a fair market pre-money value at the VC or angel stage.
Yeah. So one of when I first got started in this space of, angel investing and growth capital and all this kind of stuff, and I was going to these events called the Association for Corporate Growth, which I'm sure you're familiar with. They do a lot in the M&A space, and a lot of private equity funds participate in those things. And I first kind of discovered this world of private equity, and I discovered this exit strategy for those businesses that, a founder maybe or maybe not did a friends and family round, built a business up. The next gen might want to come in and take it over, but they want to have the vision for where to go with it. And they would do, we didn't call it a leverage buyout. It was a private equity fund that was considered a growth partner. And they would come in and take equity off the table that the owner had, so the owner could start to semi-retire. And then the one or two things would happen. The second gen or third gen or whoever was, wanting to grow it bigger and expand it, would then continue on. Or you'd have a situation where that particular owner had not fully reached its potential and did want to fully exit, didn't have a second gen coming in, but they did want to fully exit out within 5 years. And so they would sell a little bit now and then work with that private equity fund to continue to grow, because they had active people in the company helping to grow, and then share in the success when the exit through acquisition to a corporate buyer happened later, or a bigger buyer. And so um is so that's where I think, because of the that I got confused in an LBO being a negative because of TV or whatever, versus the reality, because what I just described really is a leveraged buyout, right?
Right. So what you described is a leveraged buyout, and what you described is the work that I always used to do. And you're right. LBOs are vilified on TV as corporate raiders. We're going to come in, we're going to gut the place, and we're just here to liquidate it and make a profit and flip the thing. And that's fair. I mean, that can happen. Um, and I get where that reputation comes from. That was not the work that I did when I was in PE. It was much more the situation that you described. We've got a founder who's built a great business. There's a lot of enterprise value tied up in there, but maybe they want to take some chips off the table, or they have some visions for growth, but they don't really know how to execute. Private equity comes in through that leveraged buyout, buys out half of their position, roughly. Usually they take a 51% stake, re-sign an employment or consulting agreement with the founder so that they stay involved going forward. But now they've been able to take a nice lump sum off the table, semi-retire, or at least, bank the nest egg a little bit. But then we all work together to grow the company even further, and then ideally sell it again, either to a strategic buyer like you mentioned, or to another private equity firm. That's pretty common as it moves up market. And rather than raiding the place, usually what we would try to do is build a culture around the finance team and the sales team to help it grow. And sometimes people don't quite have the sophistication, and we always try to give them a chance and we help educate. And sometimes, unfortunately, they just need to be fired. It's just how it goes. And sometimes we have to bring in a more sophisticated CFO to run the playbook and run the business. But that's never our intent going in. Our intent is always to keep the team and keep the culture and just build sophistication around the existing team, because usually what kills deals is not the company, it's the culture, and it's the clash between the buyer and then the existing culture at the company. And so we want to try to preserve that at all costs. And the deals that went the best are the ones where we would keep the team, even some what we'd consider underperformers from like a private equity perspective, but culturally we all got along and culturally we all had the same vision, because then we could weather the financial storms that would come up and ultimately see those through to a positive exit. So that's really the vision of the middle market private LBO. Yes, they can go poorly, and yes, sometimes stuff gets rated, but not in that like visceral sort of nasty sense that is perceived on TV.
Yeah, I was just thinking because and it'll be perpetuated because so many people like watching Yellowstone, and I think the daughter in that's her whole thing is just really going in and destroying companies and very vindictive about how she leverages and does that kind of stuff. So um
I love that show. I love that show, and that character is amazing. But she is sort of playing into that persona of
yeah,
corporate raider, vindictive, game theory moves to kind of destroy companies. And I'm sure that happens, but that's not really how it worked in my experience. That is a great
yeah.
show.
Yeah. So, okay, so financial modeling focusing on FP&A focusing on revenue forecasts, expenses, capital expenditures that work together to determine the benefits of an investment or expansion or even acquisition of another company. Right? So, talk because you have as part of what you do with your training is navigating this financial modeling learning curve. So that what I just described there, I think every micro, now I call them a nano, it's nano market company, right? Because you got the micro cap, the nano cap. Nano cap are those companies that are trying to figure this out so they can become a 20 or $30 million company and get into the radar of a PE firm for continued growth capital because whatever reason they're not in a venture capital pipeline. So talk about how a privately held company can look at that or what they need to if they don't know this and this A B and C, they need to take your course so that they or their CFO or even I think a CEO should know it so that they know that the CFO is doing that. They don't have to do the work themselves, but they need to be able to understand these documents, these statements, to know if their CFO is got them on the right track on that. So talk a little bit about that piece of that and what are some of the things that um people that come through your course, their aha moments where they go like, oh, I never thought about using that information this way, or I never thought to go and try to gather up this information within my company because it would be a critical element of a decision process of which direction I want to take my company.
Right. Yeah. So I'm glad you brought that up. The ultimately the what I'd like to see from any company that eventually wants to be acquired or not, this is just a good discipline to build, is a three-statement model forecast, which is the income statement, the balance sheet, and the statement of cash flows. And the reason you need all three is because of this concept of accrual-based accounting, where the income statement is going to show when revenue is earned and when expenses are incurred. but it won't necessarily show when cash comes in or exits the business. And so that is going to be reflected in your modeling of the balance sheet. And that's why you need both. The cash flow statement is just the bridge between the two. It shows how the cash moves. And so as a private equity investor, what I'm looking for is ultimately a path to profitability. Even if I'm an angel series ABC, at some point, I want to know the company is going to be profitable because otherwise the enterprise value is eventually going to run out. We can't just run it negative forever. And so if you assemble a three-statement model, that helps me understand when, in theory, the company is going to become profitable by forecasting. And so the income statement is going to be the revenue and the expenses, but then the balance sheet is going to be things like, well, how much of our receivables are waiting for us at the end of each month that we have to collect on? How much debt do we have that we got to pay off that is not in the income statement? Or how much capital expense for like machinery or equipment do we have to spend each month to keep the business going that is also not in the income statement? So those are holistic pictures so that I can ultimately see what we talked about earlier. How much cash is this thing eventually going to generate? Because that's what I need to know in order to make an investment. And I think once you understand the interconnectivity of those three statements, the income statement, the balance sheet, and the statement of cash flows, you now have a playbook or a scorecard that you can use to forecast the future. And it's not going to be right. It's never going to be right.
Yeah.
But you use it directionally and you just need to make it defensible. We think we're going to have revenue grow by this amount because of something. We think we're going to be able to cut costs because of something else. And we think we're going to be able to, reduce our capital spend because of some other factor. So you're going to combine your financial forecast with operational assumptions. And now I have a holistic story that I can take back to my private equity team to see whether or not it's a worthwhile investment. And the mechanical structure of that is the three-statement model. And so that's why I've said before that it's the most impactful skill in my career. It's because it is the holistic way for a company to project the future in a language that investors understand.
Okay, very good. And I think that's, we've talked a little bit about the difference between the startup versus a growth stage type of a company and the unknowns and the uncertainties. The problems that startups have and that angels discount of VCs that we spoke about is it's a lot more fundamental of that. They don't even know where their customers are coming from a lot of times. So that's why they do percentages of markets and they don't really know. I try to push them to be better at that and have a better sense of their expenses. But um, so do you find when you go into some of these companies that um when they're trying to make a decision, they have completely not anticipated because they don't know or because they're trying to not fully disclose what their future expenses would be to in order to sustain the revenue?
Usually it's just a lack of it comes back to they don't know what they don't know. There's a lot of missing pieces because the discipline of building a financial model is a relatively new practice. And it's usually something that's kind of shoved down by investors because that's what they expect. Whereas an operating company might just open the bank account and say, okay, we've got enough cash for looks like another couple weeks, so let's just keep it going. So there's a whole culture shift and discipline shift in learning to build one of these projection models. And when you do it the first several times, well, what do we even include? I don't know what to include or exclude. I don't know how certain things move. And so sometimes if a company brings on an investment banker, a sell side agent, they will get a little bit of guidance through that, and that kind of helps the discipline, but it's a process that ultimately is pretty iterative that just needs practice and reps until you can compare how the company has actually performed and then build a more thoughtful forecast. So it really comes down to getting a grasp on the history first. And the history can also be mapped into those three statements. And so once you have that, then your groundwork and your plumbing is kind of mapped out. Then it's much easier to build out a forecast. But if you're just sort of sitting there, kind of like throwing darts at the wall forecast, it's well intentioned, but it's not going to be accurate. And that's usually what's missed. There's no there's no context to compare the history to the forecast that you're trying to build.
And so that is, and it can be very, very complex. And I think about some of the spreadsheets that I've looked at, or the ones that have lack that. When you get into, some of those nuances of cost of products, cost of goods, cost of sales, all those kind of things that become some of the soft dollars that they don't really anticipate if they're carrying their debt a little bit longer, the compounding effect of that, all these sort of different things that I think when you get in there and you're working with owners of companies for whatever reason that they're wanting to get a financial model prepared, do you have to first educate why that some of those things has an impact? Like, let's say it's their accounts payable, and the difference of they pay it off in 25 days, they may save a percentage, but if they pay it off in 45 days, it may cost them an extra 0.5%, and the actual impact of that, whereas they may just be paying the bills and they're not really paying attention to that. But do you end up having to find that you have to educate them in order for them to be able to fully trust you and give you all the numbers?
It's situation by situation, I would say. Sometimes I'll work with a fairly sophisticated CFO that just wants a little bit more of a robust or flexible financial structure, financial model. Other times there's less sophistication and there's a lot of education around the working capital cycle specifically, because sometimes they're just paying bills when they're paying them and then maybe not chasing down the receivables as much. I think I see that a lot. And the quick education on that is, let's get our receivables in as fast as we can so that we can self-fund our payables and we're not in a cash crunch. So it really depends on the style of the company. And what I would say is what I try to do a lot to avoid the complexity, because there's always complexity, is look at the 80/20 of the business and say, what are the kind of the five biggest line items that move the needle? And everything else, for the most part, is not going to be ignored, but it can at least be put on the back burner. And typically that's going to be the revenue, the cost of the products, it's like the cost of the goods sold, the head count, and then maybe one or other two large expense items that are industry specific, and then the capital expenses. So stuff that is not in the income statement, but still cash they have to spend on stuff like buildings or trucks or equipment. If we can get a grasp on those things and the levers that move those, then we can stress test the business fairly accurately in a direction where we at least know, okay, we have enough information to make a decision so that our operating team knows what to do. Because that's the goal. We need to kind of shift the winds a little bit so we know the next steps to take, as opposed to making a perfectly accurate model. Because at some point you get lost in perfection and you get away from just completing the actual work, which I think is a thing that happens to finance a lot. They want the model to be perfect, and they forget that for every finance person, there's somebody actually out there making the sales calls or making the deliveries and actually completing the work. And the scorecard, the model, is just like an abstract representation of that work.
Okay, so the other stuff could be considered rounding errors almost to a certain degree.
Yeah, yeah. I mean, I think, to speak to it tactically, I'll take small expenses and just give them an inflation growth assumption and kind of call it a day. And then if we feel like something needs more detail, well, then I'll go back and revisit it. But if we've done a thoughtful forecast on the revenue, cost of goods, the people, the capital spend, and the debt, if there's debt, I mean, that's 80% of the business right there. So if that's where we're spending our time, the rest can sort of be considered a rounding error depending on how large it is.
Okay, very good. So I want to make sure people know because that they have access to this financial modeling education.com. Very affordable education for somebody. Definitely recommend CFOs getting into it, particularly as this seems to be a trend. Anybody that's considering thinking that, you know what, I want to, all those companies I talk about in the Midland that I want to be prepared for a private equity infusion, or if you're one of those companies that's in the transitional stage of how do you transition out of your company and provide, because so many small business owners have their small business is their retirement plan. you're most likely, straight up acquisition can be hard, whereas a leverage buyout in the positive sense can be a very favorable way for you to take your company. So please visit that. And I think this has been a great session to sort of clear the air on what to expect by some of those small to nano cap size companies. So anything you'd like to add before we close here, Chris?
No. Thanks so much for having me on. I really happy to be here.
Okay, very good. All right, everybody, onwards and upwards, and tune back in next week.